Well, this is where the word depression comes in, and it confuses a lot of people because a lot of people who follow economics, whatever, they know that a recession with an R is two or more consecutive quarters of declining GDP. And most recessions are fairly short, so they are 2 quarters, some are three, some are longer, but 2 quarters of declining GDP, that's a recession. By the way, we just had 1 quarter. The first quarter was declining GDP. We may be in a recession right now. We won't know. We got to finish the second quarter. That result won't come out until the end of July at that point. And then kind of see where it goes from there. So we may, but then the National Bureau of Economic Research will make a decision. That might take a year. Like a year after the recession's over, they might say, hey, it's a recession. So we won't know for a while, but we could be in a recession right now. A depression is different. Economists hate what I call the D word, the depression word, for a couple of reasons. Number one, it's not quantitatively defined. You can define it, but it's not defined numerically in a way that you can stick into a closed form equation. So that's right off the bat, they don't like it, even though it's a real thing. There are depressions, but they just don't like to talk about them. The other one is I kind of alluded to, is psychological. If you talk about it, you might actually be in one. Well, that's just denying reality. But a depression, people say, well, if a recession is 2 quarters of declining growth and a depression sounds worse, that must be like 6 quarters or 10 quarters of declining growth. But no, that's not the definition of a depression. Depression means depressed growth relative to potential or relative to trend. So the post-1980 trend, all recoveries, is actually 4%. And if you go back to World War II, post-World War II recoveries, that trend is more like 4.5%. But if you're actually growing at 2%, you're growing, but that's depressed. In other words, if 4% is the norm and you're growing at 2%, there's a gap there. It's a wealth gap, and it gets bigger over time, by the way. So a depression is depressed growth. It's growth below trend or below potential. You still have growth, but it's a bad thing because you're leaving trillions of dollars on the table. If you could just get back to trend or just get back to potential, you would make trillions of dollars more in your economy, which means greater wealth for everybody. So depressions are real. They're serious. They can last for a long time. They can include recessions. So, for example, the Great Depression, 1929 to 1940. Okay, there were two technical recessions in the Great Depression. One was 1929 to 1933. The other one was 1937, 1938. Between 1933 and 1936, the economy grew fairly well, and the stock market went up in the middle of the Great Depression. But the problem was you were so far in a hole, you're still climbing out of the hole. If you have 25% unemployment, which we did, and you get it down to 15%, well, nice going. That's pretty good growth. But it's still 15%. It's like if I fall into a 100-foot hole and I climb out 50 feet, I'm a pretty good climber, but I'm still 50 feet below where I started. And so that's what I mean by depression, below potential growth, below trend growth for a persistent period of time, occasional technical recessions, and we may be in one right now. But basically what it means is you can't, you risk not being able to roll over the national debt. The national debt grows and it makes growth potential even worse. People can't find jobs. There are a lot of other collateral consequences from it. Lost skills, people permanently drop out of the labor force. So depressions are bad, they're serious, but they're not well understood because economists don't like to talk about them.
I see all these people out on the street and they're like begging for money, and I'm thinking, wow, there's all these jobs supposedly. You're saying all the jobs are going to go bye-bye. They're going to go away.
Well, yes and no. And when you get deeper into a technical recession, yes, unemployment will go up and some jobs will disappear. But what's missing from that, and you're right, Greg, about, I travel quite a bit, COVID or no COVID. I mean, I get around the country and, they're driving, flying, whatever. So I see the same thing. But what's missing is that, so unemployment right now, I forget the exact number, it's around 3.5%. It might be 3.4%. It's extremely low as measured by the Labor Department. It's the lowest since at least the 1960s, maybe going back even further. And of course, the Biden administration talks about tonight, we have the lowest unemployment since, whatever, John Kennedy or however far back you want to go. That number is low. But if you have left the labor force, you're not counted as unemployed. In other words, that's a fraction. It's the number of people of jobs divided by the labor force. but the labor force itself is a defined term. If you're not working, you have to be looking for a job, doing interviews or answering one ads or showing up at the labor office or whatever it might be, to be counted among the unemployed. But there are, and estimates vary, but perhaps 10 million or more Americans between the ages of 25 and 54. I'm not talking about 70-year-olds who still want to go to work, and that's fine. I'm not talking about 19-year-old college students. I'm talking about people between the ages of 25 and 54, prime working age, who are not in the labor force. They're not looking for jobs. Now, there are always legitimate reasons for that. You could be a homemaker, you could be a student, maybe an early retiree. So you never get to 100% labor force participation. But labor force participation since around 2000 has declined from close to 70%. Today it's around 63%. Now, there was a big boom beginning in the 70s as women entered the workforce and previously not counted as unemployed, but now they're looking for jobs and they got jobs. So that was a massive expansion of the labor force and added to a lot of productivity in the 80s and 90s. But that's over. Now it's going the other way and people are dropping out. So my point is, if you took that group I described who are not, they could have jobs, but they're not in the labor force, they're not looking for jobs, and added them to the denominator of the fraction, the numerator, unemployment would actually be more like 10 or 12%, which is recession or even depression level unemployment. So I don't put much stock in that low unemployment rate, the 3.5%, maybe 3.4, whatever it is, because it doesn't count 10 million or more Americans who could be working and are not even looking for jobs. You put that group in the mix, the unemployment rate would go way up. So again, I don't buy the happy talk from the White House, because they're ignoring a huge, potentially productive cohort of Americans who basically given up. They're kind of on the couch, eating Doritos and watching NBA playoffs or whatever it may be. I'm not disparaging anyone. I'm just saying it's a reality, and you have to include those people if you want to see what unemployment really is.
Are the markets going to tank? I mean, you've seen all the run into the markets with almost seemingly on bad news. Are the markets going to tank in your estimation?
Well, the answer is yes. Let's define tank. So right now we're in a bear market. A bear market can be prolonged. And bear markets are funny because there are all these rallies. I mean, just the other day there was I'm looking at the Dow Jones, I think it was a 400-point rally, and everyone goes, oh, see, happy days are here again. And then the next day it was down 600 points. So net down, but with a big day in between. I don't hold myself out as a technician. I'm a macro analyst, and I look at fundamentals, I look at other factors, but I'm basically a global macro analyst. But I do look at charts and I pay attention to them, even though I'm not, I don't, again, hold myself out as a great technician. But if you get away from the day-to-day, the stocks go up, the stocks go down, and people have the attention span of insects. They just don't really have long attention spans, it's another story, but it's unfortunate. But if you look at a one-year chart of any of the major stock market indices, let's just take the Dow Jones because most people follow it. It has what's called a head and shoulders pattern. So head and shoulders pattern is it gets to an all-time high, it goes down, okay. It goes up to a new all-time high, and then it goes down again, and then it comes up again, and people are expecting a third all-time high in a row, but it doesn't. It doesn't get that far, and then it starts to go down. So you have the head in the middle, and you have these two shoulders on the side, peak, bigger peak, and then another peak. So it just kind of looks like your head and shoulders. But what that signifies is if the third rally couldn't surpass the second rally, you're now in a downtrend, and that consists of what are called lower highs and lower lows. So yeah, you'll have rallies, you'll have big up days, but you'll never get back to that last peak. And then you'll have down days and down weeks, and you'll go lower than the previous low. So the trend is lower, even though you have these big days. So those big days are called bear traps or bear rallies or whatever, but they kind of fool people into thinking that the market's still strong when it isn't. But if you, again, step back, look at the bigger picture, you'll see we're in a downtrend. So that's a bear market. They can go on, I remember 1969 to 1982, it's at 13 years. And yeah, there were rallies along the way, but there were awful. There were three recessions in that period: 1974, 1980, and 1981, and there were awful dips. But there were some rallies too. But the overall trend was kind of actually it was down at times, but ended up flat. What was interesting about 1969 and 1982 is you ended up where you started. The market didn't go anywhere for 13 years.
Wow.
So, but it included bear markets along the way. So we're in a bear market now. It can last a really long time, and that's really the point. Now, a crash is different. A crash is when you just, you open a trap door and it goes straight down, 20%, 30%. They happen more often than you think. It happened in March 2020 during the height of the COVID panic. The market was down 30%. Certainly happened in 2008. Happened again in 2020. In 2001, the NASDAQ crashed 80%. Took 15 years to recover. Everyone's like, hey, NASDAQ's at an all-time high. Well, yeah, it has been recently. It's off the top, but not that long ago it was at an all-time high. But they forget that it crashed 80% in the dot-com bubble and took 15 years to come back. So that's what a crash looks like. That's what a bear market looks like. So
you think we're going to get
crash? I would say yes, because
wow.
Yeah, I think we are, and maybe later this year. And let me, if I can, Greg, I'll give you some very specific analysis behind that, because I don't like to make claims without kind of backing it up. We've seen this movie before, beginning in 2013, and I'll be succinct. 2013, interest rates were zero, and we had quantitative easing under Bernanke. And Bernanke said, we're going to taper. He didn't use the word taper, but basically reduce long-term asset purchases is the phrase he uses, meaning we're still going to print money, but we're going to print it at a slower pace. And everyone said, well, that's not tightening because you're still printing money. Well, it is tightening, because when you do anything at a slower pace than you did before, you're reversing course. So that is a form of tightening. That was enough to send emerging markets into a tailspin. And then it was going to start the taper in September 2013, chickened out. They actually started in November 2013. It lasted a year. So by November 2014, the taper was done. Now, they still hadn't raised rates, but they did reduce asset purchases to zero. So there was no new money printing. Then a year later, December 2015, Yellen raises rates. Took another year for the second rate hike. That was December 2016. Then Powell comes in, and then they started like clockwork, 25 basis points, 8 times a year, boom, 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 boom. Got it up to about 2%, got raised off of zero up to about 2% by September 2018. What happened next? The market collapsed. Between October 1st and December 24th, 2018, what I call the Christmas Eve massacre, the market fell 20%. And in fact, the Fed kept tightening into that weakness. The Fed tightened. They did their last interest rate hike in December 2018, even after the market was down about 15% at that point. And then Christmas Eve, December 2018, the market fell 3% in one day. And at that point, Powell got spooked. And then first week of 2019, he comes out and says, that's it, no more rate hikes. And then about a couple months later, he says, by the way, we think we're going to cut. And then they did. And then they said, on top of that, we're going to do some more QE. I forget if that was QE6 or QE7. Depends how you count. And then, of course, 2020, here comes COVID. And where are we by April 2020? Interest rates are back down to zero. And the Fed's balance sheet was expanded to $7 trillion. So in other words, not only did the Fed fail to normalize is when you get rates around 2.5, 3, and you get the balance sheet down to maybe 3 trillion. That would kind of look normal. The Fed failed to do that. They trashed the stock market in the fourth quarter of 2018, reversed course, and got all the way back down to zero, and expanded the balance sheet to $7 trillion and did more QE. So none of that was a failure and a complete reversal of course, but they ended up worse than where they started in 2013. So 2013 to 2020, 7 years, and they ended up back where they started in terms of rates at zero, and worse than when they started in terms of balance sheet, which was 7 trillion. So that shows two things. Number one, the Fed completely failed. And number two, they did trash the stock market down 20% in 3 months and got very close to doing worse. Now they're trying to do the exact same thing. What are they
Yeah.
doing? Well, March they raised rates. In May, they've already told us they're going to raise 50 basis points. June, 50 more basis points. 25 basis points probably in, July, September, November, and the other meetings throughout the end of the year. And they've completed the taper, so they're not printing any more money. And probably in May, they're going to announce more quantitative tightening, which means you actually reduce the money supply. So this is triple tightening, big interest rate hikes, no more taper, obviously, doing quantitative tightening at a very rapid rate. So what just happened? We had a down quarter. The economy was at recession levels in the first quarter, and the stock market's on the way down. So here we go again. The Fed is tightening into weakness, tightening into economic weakness, tightening into what was certainly a stock market bubble. They'll probably destroy the markets again. Now, except with one big difference. The last time it took 7 years to do the round trip, and it took 5 years to trash the market. But the market kind of wised up. They've seen this movie. They know the Fed can't do this without causing recession and trashing the stock market. So they're not going to wait 5 years this time. This is going to probably come to a head, I would say late this year, early next year. But yeah, you'll see a short stretch when the market drops 20% or more, maybe 30%. I would call that a crash, on top of a bear market, on top of a recession. Only then will the Fed wake up and say, maybe we ought to stop cutting rates, but it'll be too late by then.
When you say too late, it'll be the markets will be damaged pretty bad.
Correct. The Fed's always the last to know. Like, I know, we just told our viewers what's going to happen. There are a handful of other analysts who know. You don't have to have a crystal ball. You just have to know how markets work and how dynamic systems work. And again, learn from history, because the Fed already did this. So eventually people will catch on. The market will catch on. People will bail out. They'll go to cash. And the Fed will be the last to know. And it's not because they're dumb. They have the IQ points. But they have badly flawed models. And one of the long list of them, I could name, the wealth effect and inflationary expectations and others. But one of the really bad models for this point is the Phillips curve. And the Phillips curve assumes that there's a reciprocal relationship between unemployment and inflation. So in other words, if unemployment's really low, then inflation has to go up. And so the Fed has to raise rates to kill inflation. And then when inflation comes down, maybe unemployment goes up, because at that point you're in a recession. There's no empirical evidence for that. I mean, it happens sometimes, but the opposite happens. Sometimes you have, in the 1970s, where we had high inflation and high unemployment. In the 2010s, we had low inflation and low unemployment. So there is no correlation, but they think there is. And they're completely ignoring what we talked about earlier, which is the unemployment rate doesn't say anything about unemployment, because you're not counting all the unemployed people who aren't counted. In other words, they're out of the labor force. When you think of that as potential slack, people who could come into the labor force if you paid a high enough wage, and maybe employers would get to that, then you realize the danger of inflation from that side, from the demand side, is not that great. Now, there is inflation. There's no denying it. But the inflation that we're seeing right now, and it is the worst in 40 years. I mean, you can't argue about it. It's there. You can argue about whether it'll last or not, but there's no denying that the inflation is front and center. But the inflation we're seeing now does not come from the demand side. It does not come from consumers. It does not come from high inflationary expectations. It's from the supply side. It's because of the war in Ukraine, supply side disruption, the zero COVID policy in China, locking down two of the biggest cities in the world. Beijing has 22 million people. Shanghai has 26 million people. And Beijing, the Communist Party of China, locked down both cities because a relatively small number of people had COVID. And they've got this stupid, idiotic zero COVID policy. You might as well say zero colds. We're going to have a policy that says if anybody gets a cold, we're going to lock down, one of the biggest cities in the world. You can't stop COVID. The virus goes where it wants. The one thing that does stop it, that turns it from a pandemic to something you can kind of live with, is herd immunity. In other words, if enough people get it, forget the vaccines. The vaccines don't stop you from getting it. They don't stop the spread. They do reduce severe symptoms in some cases, but that's a very different thing from saying it prevents you from getting it, because it doesn't. I mean, there were 5 million Americans who got the Omicron virus in late 2021 who were double vaxxed and boosted. So there's your proof. We knew this doesn't work. We knew it 2 years ago, but when it first came out, but even for the doubters, the vaccine brigade, whatever you want to call them, there was overwhelming empirical evidence that the vaccine does not stop you from getting COVID. And you actually don't hear much about it now because all the big mouths in Washington got it, and they all got COVID, and they were all double vaxxed. But my point is, the way you do get through it is with herd immunity. The vaccine is getting COVID. You get COVID, and the fatality rate is very low, and there are treatments. But if you get it and come through it, which with a mild case, which is true in almost every case, the natural antibodies you get from having COVID are the vaccine. Getting the disease is the vaccine. You're much less likely to get it twice. China never did that because China was their vaccines really weren't very good, but because they were so fanatical about squashing it in every instance, they never got to herd immunity. They're still not there, and they're not going to get there if they keep up this idiotic policy. But there's a political aspect to it. The 20th National Congress, which is a big deal in China, is in November. That Congress will ratify Xi Jinping as the new Mao Zedong, the dictator for life, in effect. They've had a tradition, goes back about 25 years, but for China, that's a long time, where the leader does a term and then does a second term. These are 5-year terms. You do 2 5-year terms. You get to be leader for 10 years. But in your second term, you announce your pick to replace you at the end of the 5 years. So you already know in advance who the new guy is going to be. And it's just very smooth and consensus driven, and the leader operates by consensus. We saw this through Jiang Zemin and Hu Jintao, and started down this road with Xi Jinping, except he decided to break the mold. And he's at the end of his second 5-year term. He should step aside in November and have a new guy come in, but he's not. So this 20th Party Congress, or National Party Congress I referred to, is where he's going to be made dictator for life. Well, between now and then, between here we are in the spring of 2022 and November, he doesn't want to rock the boat. He doesn't want any trouble. And so they're going to do this stupid policy, and it is stupid, as if they're doing something smart, but they're going to make it worse. But as far as the United States is concerned, getting back to our discussion about the Fed screwing up the economy, which they will, what's going on in China greatly disrupts supply chains, increased costs, reduces global output, and makes things in the United States more expensive, messes up the transportation lanes. Don't forget, it's not just inputs and manufacturing. You got to put things on vessels and move them across the Pacific Ocean. Well, they're backed up like crazy. They were backed up at the port of Los Angeles trying to unload. Now they're backed up in Ningbo, which is the port near Shanghai, and elsewhere, waiting to load. But they can't because the place is locked down. So, and then don't get me started on the war in Ukraine. That's another whole fiasco. But we got multiple, between the COVID lockdowns in China, the war in Ukraine, the elimination of Russian and Ukrainian exports, the scrambling of supply chains, hangover effects from the trade war that Trump started in 2018, plus lack of consumer demand because the necessities are doubling and tripling in price. By the time you get done paying for gas and groceries, if you can, there's not much left over to take your spouse out for dinner or go to a movie or shop on Amazon. So that's going to kill discretionary spending. That feeds into the stock market. It's a pretty bad concoction we've cooked up here.